All right. Thanks everybody for attending. I appreciate it. My name's Jarrod Hageman here at the Noble Group. Looking forward to spending a little bit of time today to really go through the triple tax benefits of health savings account and how that could be a potential, how that can help you save for retirement potentially. I do have a little bit of a cold here, so I apologize for the raspy voice, but you'll have to bear with me today. Of course, I do have the disclosures is always really the intent here. One, to thank Franklin Templeton, who helped with the PowerPoint for this health savings account presentation. Also, this is not tax advice or legal advice, but really just intended for educational purposes. So hopefully this is helpful. And with that, let's just jump right in. We're fortunate here at the Noble Group to work with, just thousands of individuals and help them, achieve their retirement goals and see those retirement goals through. But what we know is when you think about retirement, sometimes often overlooked, but a very, very big bubble here to focus on is healthcare costs. And if you focus on healthcare costs or don't, really, that's going to impact how you achieve really your goals in retirement. And we also there's been relatively new HSAs have been around for a while, but looking at them in this new lens of how they could potentially be helpful for individuals in retirement is somewhat of I find a strategy not utilized by many or just unfamiliar. So that's the goal today, is to get you familiar with this strategy of potentially looking at your health savings account, not only if you're eligible, and not only to pay for your health costs today, but potentially investing that money and looking that in the future. So when we think of retirement, of course, we really think about our essential costs and our lifestyle costs. We like to dream about where we're going to go on vacation and what we're going to be doing. And of course, people have a pretty good handle on the expenses, that the house might be paid for. They know how much they want from a monthly perspective on a budget perspective. But really, the big question mark becomes healthcare costs. And what we know is it's playing a much larger percentage of what people need in retirement. In fact, here's a chart that goes back to 1959, where healthcare as a percentage of expenditures really represented well under 10% for most individuals. That's now up to 17.3% on average. Of the costs of what people really earn from an inflationary perspective are going towards healthcare related expenses. And we know it's going to just for couples today, it's hundreds of thousands of dollars which we can potentially spend, and specifically in retirement throughout their retirement lifestyle, throughout their retirement, where they're going to spend those hundreds of thousands of dollars on healthcare expenses. So how can we do that potentially more effectively? And this is where health savings accounts come into play. All right. So for those of you who are not familiar with a health savings account, it's a companion. It goes in conjunction with a high deductible health plan. All right, so you have to have a high deductible health plan, and then you can open up a health savings account, and it allows you to save money tax free, and that's the big key right there, tax free, to pay for qualified medical expenses. Who is eligible for an HSA? And these are some important topics right here. One, you do have to be covered by a HSA qualified healthcare plan, which is a high deductible healthcare plan. I'll spend a minute on that here in just a second. But that's one. And your employer might not offer that currently. That's okay. This is for educational purposes only, or it might not make sense for you to be, from your medical expenses, to be in a HSA qualified healthcare plan. But for those of you that have that option and that makes the most sense for you, is to be in a high deductible healthcare plan where you have an HSA. That is the focus right now, is to make sure that those of you who are in that are aware of what the HSA can do for you in retirement. So one, who's eligible, covered by an HSA. Two, not a dependent on another's tax return. So this is a strategy sometimes people ask me about if they have dependents or younger individuals. Can I contribute to their HSA? Well, if you're claiming them as a dependent, you can't be a dependent and contribute to an HSA. You can't be covered by any other health insurance plan. Now, that doesn't include dental or vision or gap insurance of that nature, but your primary insurance has to be that qualified health HSA, high deductible healthcare plan. And then lastly, not enrolled in Medicare. All right. So if you enroll in Medicare, you're not eligible to contribute to an HSA. So this is only if you're in that high deductible healthcare plan. I've mentioned this several times. What is a high deductible health? It's an insurance plan with a lower premium. So the costs, the premiums that you pay to have that coverage are lower, but there's a higher minimum deductible. So really, it can be, the first several $1,000s out of pocket for your medical costs you have to pay for before insurance really kicks in. And that's what a high deductible healthcare plan is. So when we look at HSAs, I mentioned tax-free. So what are these tax advantages? Because that's the primary driver of why HSAs can be such a powerful tool for retirement. So one, contributions are not subject to income tax. So the money that you're contributing into your HSA, your health savings account, you're not taxed on. You're sheltering it from taxes, which is right. It's reducing your taxable income in the year that you make those contributions. Also, the earnings are tax-free. So if you choose, and we'll talk about this strategy, to invest that money and it grows, the earnings, that growth in the HSA account is also tax-free. And then lastly here, withdrawals. And this is what makes HSAs so powerful. Withdrawals are tax-free if used to pay for qualified medical expenses. Okay, and that's the key there is it's got to be a qualified medical expense. And all those withdrawals come out tax-free. So a couple of characteristics here, as I mentioned, the contributions are pre-tax. That includes avoiding, FICA and FUTA on the payroll tax side and payroll taxes. There's no income limit. So regardless of how much money you make, you can still contribute to your health savings accounts. Um, contributions do not have to come from earned income. All right. So you don't, IRAs, individual retirement accounts, usually to contribute, you have to have earned income. That's not the case with HSAs. So you don't have to have earned income. Your earnings grow tax-free. And the other thing, and the importance on this slide and why I brought this slide in is HSAs are portable and transferable. So this is your account. It's not a use it or lose it. If you have an HSA and for some reason change employers, you can always roll your HSA to your new employer. Or just retain it at the prior employer. It's your account. All right. And then the big, of course, tremendous benefit here is the tax-free withdrawals, which from a federal and state perspective. All right, how does it work? All right, so one, you get started, into a high deductible healthcare plan where premiums are typically less than traditional health plans, and then the money that you save or you kind of put aside on the premiums, you have enough of a budget to set that in and invest and contribute that into your HSA. Those contributions are all going in pre-tax. All right, and it's coming through payroll deductions. And then your employer may or may not offer an employer match as well. Just realize if your employer makes a contribution to the plan, the limits include you and your employer's contribution together, so that your employer's contribution cannot exceed that limit. Then you want to maximize your saving. All right, HSA balance rolls over from year to year. Right, so if you don't have healthcare expenses that year, hopefully you don't. Right, you're all in good health. You can just continue to keep that money that you invested in the HSA and the investment and invest that money. And that's an extra step that you need to take. So not only do you make the election to contribute to the HSA, but then you log into your HSA provider and choose to move over a portion of those assets into investments. Okay, and that's where you can hopefully have some growth potential over time. It's also, of course, easy to use. You can pay, with debit. If you do have medical expenses, you can pay debit cards, qualified medical expenses very easily through your HSA. The uh, payment, all right. So the money that comes out, what are these expenses used for? And of course, for most people, and this is what we see today, most people use their HSA to pay for the medical expenses today. All right, and those, of course, are doctor visits and diagnostic tests and prescription and eye dental and so forth. But there are a pretty extensive list of what you can use your health savings account for. And I actually just downloaded this list here, but that includes nursing services, physical therapy, weight loss programs, long-term care premiums. You can also use them, for wheelchairs, hearing aids, Medicare premiums. So you can use your health savings account to pay for your Medicare premiums. Of course, all co-pays as well. And a lot of that the additional items that I listed there are really can be quite costly for people in retirement. Hearing aids, for example, can easily be $5,000 to $8,000. So you can use your health savings account that you've been saving in over the years, and hopefully, right, if you can investing in that growth to pay for those expenses later on in life. Now, when we look at those qualified withdrawals, you can use those qualified withdrawals every year or in the future. All right. But one of the questions I sometimes get is, well, wait a minute. What if I end up saving in this HSA year over year? Hopefully you've accumulated money. What if I don't have enough healthcare expenses for that HSA to cover? One, the health savings account, you did still take advantage of the pre-tax contributions and the tax deferred growth. And you can think of it really almost like a traditional IRA or a pre-tax 401k plan, where those assets, you still got the tax break, you still got the tax deferred growth. And then if you take it out for non-qualified medical expenses, you do have to pay taxes then. And as long as you take those distributions after age 65, all right, so this is not to be confused with 401k plans. With 401k plans, usually the magic age is 59 and a half. With health savings account, it's age 65. If you take money out of your health savings account after age 65, and use that money for non-medical expenses, right, you will pay taxes on that, but there's no penalty. If you take it out before, though, for non-medical expenses, there is a penalty, and that penalty is 20%. So this is just important to note when you're thinking about saving and using this as a strategy. Really, you really want to focus on keeping this money for medical expenses to take advantage of the triple tax benefits. All right. How much can you contribute? So for 2025, if you're single, the limit is $4,300. If you're a family, it's $8,550, and there is a catch-up contribution of an additional $1,000 from if you're age 55 or older. So it gets you a little bit more that you can contribute into this plan. As I mentioned, you've got to have a high deductible healthcare plan. Those minimum deductibles for self are usually $1,600 or $3,300. You might see much higher deductibles though as well. But want to make sure that this is the limit, that $4,300 and that $8,500. You're aware of those. That's how much you can contribute each year. The common confusion we get here on health savings accounts is confusion with flexible spending accounts or other medical accounts. All right, and I want to reiterate the health savings account, the HSA. That is your account, all right, that you're contributing money to, and it's not use it or lose it. It accumulates year over year. You can roll over the funds. There's no limits, right? Or timing on the funds. You don't use it or lose it. It is your account that you move and can keep throughout your working career. Now, unlike a flexible spending account, those accounts, generally tend to be use it or lose it. So, if you want to be really cognizant of how much you contribute in those accounts, so that you have enough medical expenses to utilize the full amount. That's not as much of a worry with your health savings account, because if you don't have medical expenses that year, which is fortunate, you can just keep that money in the account. So that's an important difference and distinction between the health savings account and other flexible spending accounts and other accounts. Now, we also sometimes get confusion on, well, what account's best for me? Should I save in my 401k? Should I save in my HSA? Should I save in both? And of course, it's going to your personal situation impacts that. But of course, you always want to save in your retirement plan and maximize any employer contributions that are available. Never turn down free money. I think the statement goes. So take advantage of the employer match that's offered. And whether you choose to do that as a pre-tax contribution into your 401k or into a traditional IRA, right? That might make sense for your personal tax situation. And in that case, the money that you're contributing is pre-tax. It goes in. The money coming out is taxed. And this RMD stands for required minimum distribution. If you contribute to pre-tax to a 401k plan, when the money comes out, it's taxable. And starting at age 73 for this year in 2025, if you're age 73, required minimum distributions apply. Now, you might also then consider, well, I'm going to do a Roth 401k plan, and that's a post-tax contribution. So the money going in is after tax. All right. But, the withdrawals, the money out, are tax-free. And there's no required minimum distributions. So whichever route you go on the 401k, whether that's pre-tax, Roth, or both, all right, that's going to depend on your personal tax situation. But the differentiator here is the HSA is the triple tax benefit, where it goes in pre-tax or tax-free. It comes out tax-free for healthcare costs. All right. So that actually, there's an advantage here, a tax advantage on the HSA, specifically when the HSA is used for those healthcare expenses. There's also no required minimum distributions on your HSA. So that also kind of an added benefit there. But once again, the takeaway of this slide is take advantage of any employer contributions that you're saving, in your company's retirement plan. But then you might want to look at and consider saving in an HSA as well as a retirement account. So how does this strategy works? And I think we're going to kind of wrap up the next maybe 10 to 15 minutes. We'll wrap up the meeting talking about some strategies. So one, you've got your HSA eligible expenses. So we're going to pay via funds via HSA, or the strategy here could be those healthcare expenses today that you're experiencing. Don't use your HSA to pay for those expenses. Leave that money in your HSA. And if you're in a fortunate position where you can afford to pay those medical expenses out of pocket, hold on to those receipts though, and then let that money be stay invested in the HSA. Right here in this little purple circle, continue to grow the HSA assets tax-free, and then withdraw tax-free for any purpose at retirement for healthcare expenses. And what this chart is really trying to say is you can get reimbursed for your medical expenses that you're experiencing today if you save that receipt at any point in time in the future. So I don't know many stories, but I've talked to people that have saved all their major medical receipts for upwards of 10 years. And then at retirement, submitted those receipts to their HSA and then received, thousands of dollars of reimbursements for those health expenses that they experienced 10 years ago. And that was all then kind of kicked off tax-free income for them in retirement to in this case it was to go on a nice cruise. So but this is a strategy, all right? So keeping those old receipts, you can turn those in the future at any point in the future, but in the meantime letting that money stay invested in the account. What a benefit for you. All right. So investing your HSA assets. This takes action. All right. So one, when you establish your HSA, typically your HSA assets, you got to meet the minimum cash balance. So in most HSA providers, that minimum cash balance, let's say, is $1,000 or $2,000. I've seen some that might be $2,500. So you need to at least accumulate about $2,500 in the cash account. Once you've got that account, that amount established, and you've saved enough to maybe pay for your annual deductible or cover maybe some out-of-pocket costs, the additional money in the HSA, you can move that and invest those HSA assets. And that does take action on your part. And I talk to so many participants that aren't aware that it takes that action. So you can every year, if you're a family, contribute over $8,000 into your HSA. After a couple of years, that could be $24,000. You can move over 20 of that, for example, into the investments, and then also change so that your future contributions from payroll are being contributed into the investments. And this is going to be a great way in which, right, over time, right, as hopefully those investments appreciate, subject to your investing, where you invested that money, you're going to be able to hopefully see growth in that account. So this is my favorite part of the presentation series. We go through some hypotheticals, and then I'll end the recording and we'll cover some questions. But here we've got Will and Melissa, and I think this kind of wraps it all up. So Will and Melissa, they're both 65, they're retired. So their hypothetical healthcare costs for their retirement over their lifetime from age 65, right, for the rest of their life, they're estimating around $262,500. So if they were to spend that utilizing their 401k plan in a 25% tax bracket, they're going to need to take withdrawals of about $350,000 to cover that $262,000 of expenses. Apologize for my throat. Now, if they happen to have used this HSA strategy and were able to accumulate, over 10, 20, 30 years of investing, enough they could and used their HSA for this, they would have saved $87,500 in taxes. So that's just a tremendous benefit, the triple tax benefit, those tax-free withdrawals at retirement. That's hard to, it's easy to quantify in this example and is meaningful. All right, so now we've got another strategy that very few people are aware of, and it's not commonly used, but I think it's appropriate to know about, which is the ability for parents, if you're in this position, to help your children by contributing to an HSA account for them. Now, this is once again somewhat limited, but we've got Alan and Linda here. It's and by limited I mean it's a limited window. There's a kind of some age requirement. So Alan and Linda, both are age 53, are married and have a 23-year-old son, Brad. All right. All three are covered under the family high deductible healthcare plan. All right, and that's the key. They're all covered under the same, which is very common. A lot of children, if you have children, they go off to college, they're still covered under your healthcare insurance, right, through Linda's employer. At some point, though, Brad here is 23, so Brad has hopefully graduated, potentially graduated college, and might still be on the family medical plan, because you can stay on your medical plans usually until age 26. But Brad now is hopefully off, making a living, doing something inspiring, and is no longer a dependent on his parents' tax return. And that's the key aspect here: is your child but has to be on your insurance, but not a dependent. You're not claiming them as a dependent. And if that's the case, the HSA contribution, how much you can contribute to your HSA, you can fund the parents' health savings account, and Brad can open up a health savings account and also contribute up to the maximum, which was 80 a little over $8,400 this year. This is kind of a double dip strategy where for a few years there, where your children are on your insurance, but you're not claiming them as a dependent on your tax return, where if they can contribute or you can contribute on their behalf to an HSA account for them. And boy, a 23-year-old with $7,200 in an HSA account, if you invest that, what a great legacy and way to help out someone by setting them up for the long term. We got a couple other examples here, and we'll end this one with Bobby. Bobby, I like Bobby. He's 28. He's a web developer. He's single, and he's going to target retirement at 66. A couple things about Bobby here is he's a health nut. He hasn't missed work. He's active. He's gonna climb the Himalayas, and he plans to spend. He wants to be a bachelor. All right, so that's Bobby. So Bobby works from age 28 to 66, and he contributes the max allowed to his HSA each year. So he maxes out his HSA. He also contributes 10% to his 401k plan. In this case, his employer has a generous match. He invests his money in his HSA, all right, and his 401k, and he earns a pretty achievable, historically looking back, a pretty achievable 6% per year return. Okay. He never has a major medical expense. He's fortunate. And he never withdraws or takes a dime out of his HSA. He just contributes to that HSA and lets it invest over time. All right. So at age 66, we're looking at Bobby here. What's he been able to do? He's now been able to accumulate almost $700,000 in his HSA. That $700,000 can pay for Medicare premiums. It can pay. There's a lot that your HSA can be used for. If you need to make your house, for example, accessible on a wheelchair, and which can require construction. There's options in which you could potentially use your HSA for that. There's just a lot that the HSA, especially with a doctor's note, can be utilized for expenses in retirement. And then his 401k balance, he's able to amass a very healthy 401k balance. All right, so that's Bobby as a single person. And now we've got Bobby here who falls in love. And if I had sound on this slide, maybe we could play something funny, but I don't. But Bobby falls in love. And in this case, he meets Rachel. Rachel, at age that Bobby runs into a lawyer named Rachel. They meet. They get married. Rachel is an attorney at her firm, and she has great insurance and has no plans to give that up. How does Rachel's health insurance plan affect Bobby's ability to keep his high deductible healthcare plan and contribute to his HSA? In this case, it has no impact, okay, because Bobby is going to continue to be on his high deductible healthcare plan with his employer. As a result, he can contribute to his health savings account, whereas his spouse, Rachel, in this case, continues to be on her insurance. Now, we got another little twist. So 4 years later, Bobby has twins. I'm a twin, so I like this slide. And now we're looking at Bobby, age 40. He's an entrepreneur. When the twins are born, Rachel adds them as dependent on her insurance. Okay. And a little twist here, just before his 40th birthday, Bobby's company is sold. and he loses his job. All right, so he is now no longer covered by his own high deductible healthcare plan. So Rachel adds Bobby to her health insurance. So now he's no longer in a high deductible healthcare plan. What does Bobby need to do with his HSA? Nothing. All right. He can no longer contribute to his health savings account because he's no longer covered by a high deductible healthcare plan. But his HSA can stay there, can stay invested. He can roll that to a provider of his choice. And it can continue to be an account for him to utilize for him and his family, or for retirement needs in the future. Okay. So in this assumption, all right, from age 28 to 40, Bobby contributed the max to his HSA. He continued to do his 401k, which was invested. He never had, a major medical, expense that caused him. So instead of going to 66, he just stopped at 40 after he lost his job. What's he going to look like? Well, his HSA balance, because he left it there, continued to grow to up to $323,000. A very significant sum to cover medical expenses, and his 401k balance, over $1 million there. So it can be just a very significant tool to utilize to really accumulate, on a tax advantage perspective, large sums of money for your retirement needs. So to kind of wrap things up here, 10 things you should know, right? So there's tax efficiency of your HSA. It's triple tax benefit, which is phenomenal. The contributions are going in before taxes. Family coverage, if need, your HSA can be used to pay for qualified medical expenses for a spouse, a child, or if they are covered under, even if they are covered under another medical plan, all right? Keep it rolling. All right. You can roll over your HSA. So always keep that, keep that in mind that you can roll that over. Required minimum distributions start at age 73, but those actually don't apply to HSAs. You can keep a paper trail. So any expense, medical expense that you have over the years that you don't get reimbursed, you can save that and get reimbursed in the future. It's a great way. Your employer may or may not contribute, but that does count towards the annual limit. And just keep in mind, skipping over here to number 9, penalties, distributions before age 65 that are not for medical purposes, you do get taxed on those and pay a 20% penalty. So make sure you keep that in mind. And then start saving faster, right? So some providers offer immediate investing. So once you've hit that, 1,000 to 2,000, or maybe there's not a limit depending on your HSA provider. The quicker you can start selecting investments and investing for your future, that's a great way to hopefully grow that HSA account. And then there's no income limits. All right. So regardless of how much money you make, really anyone can contribute to that HSA. And with that, I'm done. I appreciate you all attending today. I have a few questions, it looks like here. Let's see if I can dive in and read some of these questions. And feel free to use the Q&A if you have any questions. One question here is, are we going to get a recording of this in email? We are going to record this and get this approved and send this out, so your employer will distribute that. Can you switch from a high deductible healthcare plan to a PPO and still use your previously deposited money in your HSA for medical expenses during the PPO period? Second, can you restart contributions to the same HSA if you switch back? That's going to be a really that's a very specific question. You're going to want to, reach out to your healthcare providers on that. Of course, when you switch to a non-high deductible healthcare plan, you're no longer able to contribute to your HSA, but HSA withdrawals for qualified medical expenses, even if you're covered by another plan, those still can be utilized to pay for qualified healthcare expenses. And then second here, the second part of that question was, can you restart your contributions to the same HSA if you switch back? And the answer is absolutely. So if you're covered by a high deductible healthcare plan, and that plan and your employer offers the same HSA, yeah, you can contribute right back to that same HSA. Is there an impact if we close? Is there any impact if we close the HSA account? Well, if you close an HSA account, and I'm making the assumption here in this question that you'd be liquidating it, right? And if the money comes out and it's not for qualified medical expenses, well, then yeah, there is an impact. You could pay taxes on that and potential penalties. But as long as the money is coming out for qualified medical expenses, well, then the money comes out tax free. So one question was, what are qualified medical expenses? That's really almost all medical expenses, dental, vision. As I mentioned, long-term care, Medicare premiums, co-pays, nursing services. There's just allergy treatments, surgeries. The list is quite extensive. And your HSA provider and your medical providers, I'm sure if you go to their websites, will list out even more comprehensive lists of all those, or you can do a quick Google search as well. Does the eligibility for the $1,000 catch-up on contributions start in the year you turn 55 or the following year? It's the year you turn 55. So in that year that you turn 55, you're able to do that $1,000 catch-up. All right. If I have an HSA account, can that be used by my spouse to benefit for tax-free money? Yeah. So the HSA money that you've saved in that account, you're eligible to pay. That money can come out as a qualified medical expense for you, your spouse, and your dependent children. So those are so absolutely the money can be used, for your spouse's medical expenses as well. I had a question here. Do you have to have a high deductible healthcare plan? And the answer is yes. To contribute to a health savings account, you must be covered by a high deductible healthcare plan. All right. A couple other questions here. My HSA has a minimum required balance of $2,000 for investing. And does that mean I can only invest the amount over $2,000? And that typically is what that means. If there's a $2,000 minimum, you need to first accumulate $2,000 in the cash account and the holding account before you can start then moving the additional assets that you're contributing over into investments. So that is typically what that means. And then this is a great question. Follow-up question. Wouldn't this open me up for losses if I claim medical expenses after a market loss? And that's such a great question. And the answer is yes, right? When you do invest, depending on how you invest your money, whether that's conservatively or aggressively, that's going to be dependent on the options that are available in the investment platform. But yes, if you invest in stocks and the stock market tends to be down that year, you can see fluctuations in your account up and down, right? That's the risk of investing, right? The goal of investing is over time, right? We hope with that volatility to appreciate and gain money over time. But yes, if you happen to be invested that money and the market goes down, you could see that loss. And if at that time you had a major medical need and need to liquidate your HSA, that could put you in a position where you have less money because of that potential loss, which is why it's really important to really think through how much money you want to set aside in your HSA for your medical expenses and that safety net before you invest the additional sum. All right, that's such a great question. Of course, the answer to that is it's going to depend on everybody's personal situation, but something you should absolutely consider and think about. Does the HSA account have fees after you're retired and not with the employer? Most HSA accounts, and HSA providers, there is typically some fees associated with. You need to contact your HSA provider to look at what those costs are. There can be trading costs and investment costs if you're using that investment wing, maybe distribution fees as well. Those are all going to be dependent and differ depending on which provider you use. Where can I find the list of qualified expenses? Boy, the IRS has a list. Your healthcare provider, your HSA provider is also going to provide a good list. Those are good places to start. Um, are elective medical procedures covered? Uh, that's a very general question, and I think the answer is generally yes. Elective medical procedures are covered, right? Most surgeries, excluding cosmetic surgeries. I do know that one. It does exclude cosmetic surgeries, but most surgeries, elective, right, for maybe just better health, whether you're fixing your shoulders or your knees, of course, those typically are covered. Um, all right. All right. Even with the fluctuations in the market, do you keep your principal that you contribute to the HSA? Great question. And once again, any amount of money that you contribute to the HSA that you move over into the investment wing, that investment platform, right? That's not guaranteed. It's going to fluctuate with however you choose to invest that money. So it's not a guarantee of principal there. So you are subject to the ups and downs of the investments that you choose. Another question here we got here: does the Noble Group manage accounts for customers? We do not offer HSAs. It's typically offered through your employer. You can also open up individual HSAs if you're getting your medical insurance privately and are eligible with a high deductible healthcare plan. Opening up an HSA, but we do offer, of course, the education services and can include that as an asset in our financial planning with our customers, and we do that all the time. All right, I'm seeing maybe a couple more questions. So yeah, a great question. What's the reason for conducting this session? The reason for conducting this session is retirement is such an important goal for so many people. And we just realize that the healthcare expenses that most people are going to incur in retirement are playing a major portion. And we just felt there was an education gap of this strategy if you happen to be eligible for an HSA using that tax advantage account for retirement. So the goal of this presentation was really just to educate you on this very unique strategy. It's underutilized, but a tremendous tax benefit and something we just hope more and more people know about. So please share that with anyone you know. We'll share this recording out. And with that, I've got us at about 45 minutes. Appreciate everyone attending. Over your lunch break. Have a great day, great week, and more to come from the Noble Group hopefully soon. Take care. Bye.